So that is the opportunity. The problem here is people don't know we're about to go off a cliff. They don't have an exit strategy. They're diversified, so their whole portfolio goes down, even though they think they're safe because they're diversified. And then they don't have any money to invest when the market resets. But if you can just step out of the markets or profit from the collapse, which is what we do, we actually make a ton of money while the market's correct, which is why I want it to happen. Then we have more money than we've ever had to go out and buy all these other, as an investor, I almost call them toys, like real estate and stocks and precious metals. We just go and buy our favorite things.
Think. Act. And prosper. You are now tuned into the Money Level Show.
Hello, everyone. Welcome back to the Money Level Show, where we think, act, and prosper. Today, we are joined by a special guest, Chris Vermeulen. Did I say that right?
You did.
Cool,
Yeah.
cool. I thought it looked like it sounded that way, so I'm glad that worked out. Glad to have you on the show today.
Yeah, pleasure to be here, Daryl. It's exciting to be on your show.
Yes. So, I was reading your bio. You achieved financial freedom, your early 20s. So you've been doing this for a while. And one thing that really stuck out to me is that you do not hold on to the buy and hold strategy.
Yeah.
And so could you elaborate a little more on that?
Yeah, so you can probably see over my shoulder here, asset revesting. So this is a kind of a new style of investing that really breaks free of the rat race and what everybody's been brainwashed to do in the markets. Everybody thinks you have to either buy and hold, which if you're a buy and hold investor, you got to put in your 40 years to retire. I mean, you don't see a buy and hold investor retire in their 20s. If you're a super, and the other extreme of that is everybody wants to get into active trading. They want to trade the hottest stocks and options and futures and crypto and all that stuff, thinking they're going to make it money really quick. The reality is it's like 99% of people who get into active trading lose money. You won't see them a year or two later. They're gone. So it's super aggressive, super risky. And so what I do is I focus on a strategy, which I call revesting, which is we're an active investor. I don't believe in holding anything going down. I don't believe in diversification. When you have money for the stock market, stock and bond market type of thing, that money, I don't believe in spreading your money out over like peanut butter over a whole bunch of different stuff. You got the stock market going up, you got bonds going down, you've got some of your other assets potentially falling, but they neutralize each other. Stock market goes up 10%, bond goes down 10%. You didn't make any money. So I believe in finding I follow a hierarchy of I have a special order that I follow assets that if the top one isn't available, then we move to the next one. And as we move down that list, those assets move slower and slower, but they provide different opportunities. They're disconnected from the stock market, so they can go up while the stock market goes down. So I simply reinvest my capital into whatever asset class is moving up that meets our risk criteria. And this is what a lot of people don't understand is people say, oh, I'm diversified. I have all kinds of sectors. I have ETFs. I have stocks. I'm good. I'm diversified. I got dividend stocks. What people don't understand is that the stock market is one asset class. I don't care if you own just an index ETF, which is the only thing I trade, or you own 100 different stocks spread over all sectors. When the stock market goes down, the index goes down and all those stocks go down. They're all linked together. You got to look at the stock market like the ocean tide. When the tide goes down, all boats go down. So you're either in the stock market or you're out of the stock market. That's the way I see it. And if we're out of the stock market, we're in a currency or we're in a bond play or we're in a high interest bearing type of ETF that pays a cash dividend every month while we wait for something to be in favor. So that's kind of in a nutshell what I focus on is let's just hold whatever asset's going up, one asset at a time. We don't want to own a whole bunch because if one asset's going up, the other asset's probably going down. And then it kills your return. So
Yeah, that is true. So you mentioned quite a few things that I like to plug into. So that was actually a new phrase. I'm about to start using that. So one thing is when stocks are going down, your portfolio's going down, right? And I've heard you talk about real estate. And, when I'm thinking of like real estate, me, like I own a property. that I rent out, but and I'm able to get like passive income from that. And so it's like even if like the property were to go down in value, right?
Yeah.
I'm still able to get a return on that investment. Versus like stock market, like your whole portfolio is going down, and so like I can see like even with that, even though you're talking about specifically equities and such, I was just thinking about that came to mind, which we're going to talk about REITs in a little while. Another thing that you mentioned that really stuck out is that like for me, like Warren Buffett is like the god of investing, right? He's when we look at his model or how he's done things throughout the 70s, 80s, and such, and we see this huge amount of wealth that's created, a lot of people are like, okay, invest like Warren Buffett. But then when you're like in the 9 to 5 rat race and you're trying to like, save up enough capital to be able to buy these shares, getting paid 2% on Coca-Cola stock, or, whatever the case may be, it's going to take forever. Like how you mentioned, 40 years, right? And so, for me, like I feel like I'm in this this whirlwind of okay, diversification, buy and hold dividend stocks, and then market cyclicalities and such. And so it could be a tricky thing to navigate as a retail investor for sure.
Yeah, there's so many different styles in investing and things out there that confuse people. The markets, in my opinion, aren't that complicated. The problem is the market makes it complicated, or all the people out there offering all these different things, like in different ways to do it. I haven't watched news in like probably 12 years already. I don't watch news. I don't read other people's opinions. I'll read the occasional article or watch the occasional video. I have lots of subscribers that will send me something that jives with my mentality or my analysis. They're like, "Hey, Chris, you should check this out." But I don't follow anybody's analysis because you get analysis paralysis. And I follow the charts. I could care less what the economic data is saying. I don't care what the Fed does. I don't care if everybody's piling into one thing and it's skyrocketing and I'm not in it. I don't really care. I've learned that I want to grow my capital as a whole in a conservative way, but I want to have outsized returns. And that's what I focus on, is protecting my capital, number one, but always rotating my capital into an asset that shows a strong trend that has legs behind it, lots of money flow. I use a lot of different analysis. I use sentiment, I use volume flow, I use um, trends and cycles, a whole bunch of different things, different types of data that support the analysis. So I can identify, just like going back to the whole ocean thing, I see myself as, which I am a surfer, floating out on the horizon. If you're walking down the beach, you see people, all the surfers floating out there. What are they doing? They're waiting for that clean set of waves to roll through. And they're waiting for that set. And the stock market has like 5 to 12 waves, sets that roll through every year. And the nice thing is if you know what to look for, you can see those waves coming. You pick the wave or the asset that fits your criteria. You hop on that. We ride that trend with all of our money in that particular asset. And then the nice thing about riding something with a strong trend is you also can identify when it's starting to weaken. When it's starting to break, you carve out, you get out of that trade, you move your stops up, pull off partial profits. And then we go and we sit in cash, generating monthly dividends until the next wave rolls through. But people think they always need to be in a trade. They think they got to trade a lot. And it's just, it's everybody gets overwhelmed, and really it is just follow the price. Trend is your friend. Identify strong trends so they last longer than a day or three. We want them to last several months generally. And filter out the noise, and emotions are the killer of almost everybody. So
Yeah, that's true. So you mentioned cycles, so like market cycles, and there's different cycles. So like for me and my audience, we look a lot at the commodity cycle, because you do have these super cycles that show up throughout history, and we've been in a bear market in a lot of commodities for a while with less capital expenditures, and then even when you look at capital cycles, a lot of capitals into like the highly profitable tech stocks until that becomes less profitable, and then they rotate and such. And so, what's your view there? So, like, what are the charts telling you in terms of that? Like, obviously you don't necessarily watch the news, but then like there's these macroeconomic things that I tend to look at, and I'm just kind of trying to figure the two out. So
Yeah. So there's a lot to it. The market's like an onion. There's a ton of different layers, and you gotta identify each layer, peel it back, and stack all your analysis together. So from a really high level, if we were to look at the markets, basic is we have a cycle top where there's maximum financial risk. I believe right now, anybody who's really investing capital right now, we are at this. There's not a whole lot of upside left in most assets. Real estate, even the commodity market I think the commodity market has a little push left. Stock market has a little push left, but really you're investing at a top, and you're going to have to suffer a big major pullback. And I can identify this through, there are 4 market stages. Stan Weinstein, in his book, How to Profit from Bull and Bear Markets, talks about how to identify these. We like a stage 2, which is a bull market. I like a stage 4 because it's a bear market. And they're green and profitable because they are strong trends. We make money during strong trends. A stage 3 topping phase, which we've been in since 2021 for more or less small cap stocks, mining stocks, they've been struggling. Stage 3 and stage 1s are very difficult to trade because they're choppy. They're falling in and out of favor. But Daryl, to go back to kind of what you were talking about, you mentioned there is where money's flowing. Well, there's a couple cycles here: the stock market cycle, which is the bluish cycle, and then the yellow cycle, which is the economic cycle. Well, the stock market cycle typically will top out well before the economy does. And that's because investors are savvy. They can see companies' projected quarterly earnings, getting trimmed back. In fact, there's a lot of people saying they think we've seen peak profits in the SP 500. Companies are trimming back. They're laying off people. And so typically when we get into this phase, we tend to see like gold, precious metals do well. We tend to see energy stocks do well. And we see industrial capital goods do well. And that's what you're, I think, maybe touching on there. And, we are seeing gold trading up and testing new all-time highs. The energy sector, like energy stocks, are trading near all-time highs. They have a very strong chart pattern, looking like they want to go higher. And industrial capital goods, well, this falls into like the general factory worker and operations manager, which I actually went to college for, was factory and operations management. Those people in the warehouse say, hey, we got good sales, COVID bubbles covering everything up, making them think they're really good. They don't realize there's these big cycles and that we're about to go into a recession cycle and sales are going to slow. But these factory workers are saying, we got killer sales. And probably a year or two ago, they ordered new assembly lines, machines, equipment. They're getting delivery. And the industrial stocks have been doing very well because they're landing these big contracts as everybody upgrades their facilities, their warehousing. And those people just don't know, I think the music's going to come to an end, and they're going to wish they had their old assembly line, that was paid for. And they're going to have this huge expensive assembly line with massive debt, and they're going to see sales crash. And this eventually slowly rolls into people getting laid off and businesses going bankrupt. The whole financial cycle takes place. But all these are coming together. And we are starting to see the economic data starting to turn a corner as well. So there's a lot of things coming up. Like when we look at unemployment, the 24-month unemployment moving average, which is the red line here, which is when unemployment starts to move up. Every time we have this, we have some type of financial crisis. We had the 2008 financial crisis, the tech bubble. It goes, lots of them as we go back. And that's where we are. Unemployment is starting to rise. People are getting laid off. I know a lot of business owners saying in a way, they're excited to lay off some of their staff because they can't get staff. And the staff they get, they're not real staff. People nowadays don't know how to work. They have no respect. They don't show up some days. They quit. They don't even tell you. So we're starting to see unemployment go up. And what's interesting is even though unemployment's going up, we have the government creating jobs. And we've seen this before. The government's always trying to cover up weakness. They play a really shady game. They're always dragging things out. But typically, the government starts to create all kinds of jobs to try to fill those seats. And typically when we see this, we go into the tech bubble, we go in the financial crisis. We started to see it happen going into COVID, and we're starting to see that happen again. So even though they're creating all these jobs to try and keep things held up and make the numbers look good, unemployment is still spiking up, and they can't control that wave. And every time we get into full-time employment getting laid off, which is what we're starting to see, we go into a pretty big type of market correction. And so that's kind of where we are in a nutshell. So, the sectors and the commodities and how those are moving, couple that with unemployment things starting to rise. Now, we're not officially in a recession in the United States yet, but the data is showing the momentum has shifted, but it takes time. You need a couple quarterly GDP numbers, and everybody's got their own definition kind of what a recession is. I believe we're already kind of starting one, but it's very early. A lot of people haven't really caught on yet, but it's kind of my take.
Got it. Yeah, yeah. So, I mean, like that's, what I've been looking at too in terms of just, are we headed into recession? And that's how I've been moving with caution and position sizing and things of that nature, especially like looking at T-bills in terms of, preserving some capital, gaining a yield while I'm waiting, to see what happens.
Yeah.
And so, so yeah, I mean, when recession, so you've been doing this for a while. So when recession tends to, take place, what are some of the assets? So like, for example, in 2008, like when I'm looking at commodity super cycles, okay, our last cycle was early 2000s to about 2014. I think oil topped out around that time. At least a lot of the equities, and then gold started to roll over and everything around from 2011 to 2014. And so when I'm looking at that, obviously each recession isn't the same. You can't expect it to look the same. And so, what are you seeing there on a technical basis? Time out. Quick break in the action. This message is brought to you by the Rule Symposium. This annual symposium is hosted by the legendary investor Rick Rule himself. It will take place from July 7th through 11th in Boca Raton, Florida. Mr. Rule invites some of the most brilliant minds in macroeconomics and natural resource investing. This year, featured speakers include Danielle DiMartino Booth, Nomi Prinz, Jim Rickards, Grant Williams, Lobo Tigre, and more. Rick even organizes the Living Legends panel, where he invites individuals who have built billion-dollar businesses from scratch. Attendees will be introduced to a myriad of companies active in the natural resources space, with the companies invited being the ones that Rick Rule invests in himself. The symposium is held at the Boca Raton, which is an amazing resort with exceptional amenities. I attended in 2023 and thoroughly enjoyed my time there. I went on an amazing cruise with Rick and other investors and CEOs of companies, and even had the opportunity to test drive an Aston Martin for the first time. So don't miss out on this opportunity to have fun and receive high quality education to help secure your financial future. Click the link below to sign up, and I promise you won't regret it. But if you do, Rick offers an amazing money back guarantee. So what are you waiting for? Click the link below to sign up today. Now, without further ado, let's get back to the content.
Yeah, like when we look at the commodity to equities ratio, so right now we're pretty much at like equities are highly valued and commodities are the most undervalued they've ever been, going back to the 70s. The tech bubble, as you just mentioned, Daryl, that was kind of the start or the bottom of this whole cycle. And then we rallied up and had a huge move in commodities, and precious metals and things kept on taking off after that as well. But we're back into this phase where stocks are really, highly valued, high PE ratios, overvalued in terms of the average, and commodities are fairly undervalued compared to that. Now, this doesn't mean commodities are just going to rally. What this line is saying is it's saying that more or less stocks need to fall, which will start to bring this up, and commodities need to start to rally as well. But I think stocks have so much downside. They could fall 30, 40, 50%. It'll bring this up a lot. And we'll probably still see commodities fall as well, just not as much. And because they're not falling as much as equities, this line will still continue to go up. But overall, we are, I think in 2019, we started a super cycle for gold and precious metals, very similar to kind of 2003, 2004, I think we're starting that whole phase. In fact, if we go back and take a look at gold here on a monthly chart, and this is the same with silver. Um, let me just pull the chart back here. So we had the last super cycles start, more or less kind of in this phase, or you could even argue kind of right here. And I believe we kind of started a new super cycle in 2019, and we've seen the market rally up. It's consolidated, and I think we're getting very close to a major market recession, to the bubble bursting in equities and home pricing, and so money's moving into gold as that late stage defensive play. They're saying, put me in here. I'm worried about currency. I'm worried about other assets falling. Well, if we go back in time, we saw gold do the same thing. It consolidated 2006, 2007. As the music was starting to come to an end, everybody started to get very nervous, just like right now, and they moved into gold. Gold tends to be that defensive play. And then we had a bear market in equities, or a financial reset in general, and we saw gold pull back 34%. And I believe we're going to see something similar to that. I think gold still could push up to about 2650, but then we're going to hit a recession, a bear market, and it'll probably pull gold back down quite a bit. And then eventually, once that stock market and the economy starts to stabilize somewhat, then we'll be off to this next move that we saw from 2009, 2012. Big multi-year run in precious metals. So I think there's a little bit of juice left on the upside for gold, silver, and miners, but then it's going to have a pullback. And after this next pullback, after this correction in the stock market, that's going to suck, I think, everything down to some regard. This will be like that buying opportunity where it's like, load up on gold, load up on miners, because we're looking at like hundreds or thousands of percent to the upside for that next super cycle leg. So we are like right in this point right now, as that's where I see us. And there's going to be a pullback and a hiccup along the way, which is, if it happens, is a very good sign, because it gives us that last opportunity, throw a bit more money in or put all our money in. I don't own any miners right now. I'm actually waiting for that type of correction. They're not really supporting this move that we've been seeing in precious metals. So the time's going to come where I'll want to get into miners, but it's probably going to be next year. For all we know, it could be still like 2 years away. The market has a great way of dragging things out a lot longer than we ever want. But that's kind of the view when we look at it. And silver is going to do the same type of thing. So lots of opportunity. I think uranium stocks are going to do the same. We're actually long uranium stocks right now. We were long silver miners, so we sold out of them a few weeks ago up near the highs. We hit our targets, but yeah, so the commodity space is going to be great, but it's limited upside over the next year, I think, and there's going to be a great opportunity once there is a correction.
Gotcha. Yeah. So and this is really good, a really good chart, because I've been expecting, the same thing. Like when markets go down, they pull everything down with it, and you could see that with the gold. You could see that, with all the commodity sectors, and there's like this long term, narrative or story, of governments on the clean energy, and you're seeing a lot of stuff with nuclear. So I watch a lot of news. I know you don't watch. I don't watch a lot of news, but I do try to look at, like, okay, what's going to happen in uranium and such. And so I've been seeing like the U.S. White House. They had a summit recently, and so like the government sentiment around uranium's changing and such. And so I'm like, okay, well, they're going to need that, and I'm seeing like the arithmetic around governments around the world's goals and their clean energy goals, and the lack of investment in mining. I'm like, okay, it's not adding up. Like, and so when I look at that, that's what supports like my long-term view in terms of like, okay, these miners, or these resources have to go a lot higher. There needs to be a lot more investment. However, at the same time, like we're at market euphoria right now, and a lot of the tech stocks, and everything. And so, when I'm looking at that, it's like, okay, when this comes down, a lot of these other companies are going to come down with it, almost like the COVID crash.
Yeah. Yeah. Well, what's interesting, and this is kind of off topic in a way, but you're talking about uranium stocks. And I have a good friend who used to be in the uranium business years ago. And he was, right now I'm sharing my chart. You can see URA, which are uranium stocks. I mean, they have been out of favor forever. Nobody really wants to touch them down like 94%, but they're building this giant base. They're coming back to life. And he told me this was years ago. He says the only really way to get like climate net zero is like uranium power because it is now very safe. They have small facilities. You can't have the meltdowns like we've seen in the past that it caused everybody to move away from uranium. And I think the uranium space, I really hope we have a market correction. It's bad for most people, but I can't wait for a financial correction, everything to get hit because it's going to be like a feeding frenzy in terms of it's like a kid in a candy store for an investor. We're going to be able to pick up uranium stocks, gold miners, real estate, all of that stuff, pick up the properties and actually not have to buy what's on the market available right now that doesn't fit your criteria, but the market will be flooded. You can pick up the stocks or the types of rental properties you want that fit your criteria, that have a garage and a basement and property and it's all that stuff, nice stuff, multi-family buildings, all that. And uranium space, I think, is going to be really good. And what's interesting is, and this is kind of off topic, is I'm actually producing a movie with my business partner who's produced 10 movies that have been on Netflix and things like that. And we were just in London, UK last month. We were keynote speakers at one of the world's largest clean tech and climate summits. And we're doing a movie right now where it's a teen adventure movie. And, we're working with clean technologies and there's some uranium companies that potentially get seen in the movie about how we can kind of save the planet and try and get the world down to carbon net zero. And so we're bringing in anybody who's got cool products. We're doing like product placement where they can have their product seen in the movie. We've got some amazing guys who have invented amazing products that will be seen in the movie. And that comes back to, the uranium space is that clean tech that nobody, uranium is actually pretty darn clean energy. And people don't know that. And to me, it's going to be huge. I think uranium space is going to be massive. There is a big disconnect between the price of uranium and uranium stocks. I mean, the uranium market is very weird the way it moves. It's like it's run on contract pricing. There isn't like a really floating price, I don't think. But yeah, there's exciting stuff going on.
Yeah, and so that's actually I'm interested in that movie. That's amazing. So we got to chat about that some more. I actually with stocks going down, like in the buying opportunities when people need liquidity, they do sell gold, they do sell pretty much anything in their portfolio where they can get the liquidity that they need. And so I'm expecting, even commodities to go lower too when this rolls over. Mm-hmm. And so in terms of like what emerges out of the next financial crash or whatnot. Because everything falls, and then not every sector performs necessarily performs well afterward. And so what are you seeing there in terms of like what emerges out of that? Like is it going to go back into a tech bubble? Is it going to go back into our REITs going to be in favor, commodities or bonds or so like what do you see from there?
Yeah, that's a good question. I mean, what falls in favor? This is why I see it being exciting actually is when there is one of these big financial resets. And I believe we're very similar to a tech bubble. The feeling in the market feels very similar to 2000, 2001, which I was trading and investing through. And that was like a 3-year bear market. People think like it's going to be like a flash in the pan. They'll recover in a year or so. But I mean, that was like, it took 16 years for the NASDAQ to come back. Although it is a very different scenario. Back then, tech companies were just a .com name. Like they made no money. Now technology makes more money than everything else. So there's a lot of value in technology. But when there's this financial reset, Daryl, as you're saying, what rises from the ashes the best? Like, where do you go? And the nice thing about a financial reset is almost everything rises from the ashes. Some rise just a little bit more, but you get to pick, you can move into what you're comfortable with, what you like, what you believe in at a really fair value, and then watch it mature, right? So I like multifamily real estate. If you don't have a lot of money, You can buy REITs, as you mentioned. So if we take a look at IYR, which is our US real estate REIT, it pays a nice dividend. This goes back. This is the monthly chart, and what is kind of interesting here is we are in a very similar scenario where we had a huge blow off in REITs. We had real estate top out back in 2021. In terms of the REITs, we saw that back in 2007, just before the stock market went into a crash. We saw a pullback, and then it traded sideways. This is real estate REIT in general. And then, of course, it fell and had a massive collapse on average from that price, down like 60%. Well, we're having a very similar scenario right now. We've had the pullback, we've got the consolidation. I know a lot of people actually do quite a few podcasts with real estate people, and they all sell real estate courses and they flip homes and stuff like that. And they're like super bullish. They don't like my view. A lot of them tweak it to sound like it's an opportunity. And this is the problem with so many people who don't understand these cycles and the stages. Because the four stages apply to all asset classes. It could be real estate, it could be a currency, it could be, a stock. You need to know what stage you're in and what's moving, so you know how to invest. So a lot of people are buying real estate now, and they think real estate is going to go higher. But the reality is, I think we're going off a cliff. Real estate's going to reset. And if you don't have a lot of money, that's the nice thing about ETFs, exchange traded funds, which is the only thing I trade on the indexes right now and focus on, is you can buy a REIT. You can buy this when it corrects. It'll be paying a huge dividend because it'll be undervalued. And you can buy it and you'd be like, hey, I own a whole bunch of real estate. I could buy $1,000 worth of average real estate properties. You can buy self-storage. I built and I own self-storage facility myself. You can buy a self-storage REIT. They pay huge dividends, but just think how big those dividends will be after the price gets cut in half. You'll be making even more. And so you can say, I'm going to put $1,500 into, real like multifamily, $1,500 into, or 150,000 or $1 million. You just pick how much you want to buy. You just buy the shares, right? I own self-storage. I own commercial. I own this. So there's going to be all these opportunities. I think real estate's the way to go long-term. Multifamily, 2 units or more, ideally like 4 or 5 units per building. You get the best economy of scale, one piece of property with maximum rent on it, preferably higher end rent, nice buildings, not, slums. It will save you a ton of headaches across the board in many ways. But I think uranium stocks, I think precious metals, I think precious metal miners, during the 2009 bottom. I'm in Canada, so back then I bought a real utility ETF. It was paying 16% dividend when I bought it. I held it for a year. I made 16%, and the thing rallied almost 100% in a year as well. So there's huge opportunity. You can buy dividend stocks when they get cut in half in price, and you can hold them, and you'll be making a nice monthly or yearly, return on the dividend. Plus, you're getting growth. So you really just pick what you believe in, right? And that's the nice thing is about a reset is you're buying everything at fair value, and then you can pick up and own what you want, and you can hold stuff long term because everything just got reset. You don't have to like actively trade it if you don't want to. So that is the opportunity. The problem here is people don't know we're about to go off a cliff. They don't have an exit strategy. They're diversified, so their whole portfolio goes down, even though they think they're safe because they're diversified. And then they don't have any money to invest when the market resets. But if you can just step out of the markets or profit from the collapse, which is what we do, we actually make a ton of money while the market's correct, which is why I want it to happen. Then we have more money than we've ever had to go out and buy all these other, as an investor, I almost call them toys, like real estate and stocks and precious metals. We just go and buy our favorite things, like a kid in a candy store. So don't lose money during this crash. So you should be making money and then reinvest it for some nice long-term growth that'll literally, if you catch one of these financial resets to the downside and the rebound, I mean, you can retire in a very short window of time. You can cut 10, 15, 20 years off your working life, right? If you do it right. And if you have enough capital to put into action at that time. So
yeah, for sure. Yeah, so I experienced the COVID 2020 crash, and which was nice. But I didn't know what I was investing in, and I just threw money in some stocks and made some money back, like when the market started to turn around. However, like now that I have more like conviction in terms of like what assets I want to hold long term, like I have like a watch list of what I'm looking out for. So in terms of like when markets fall, so like 2020 was like pretty. It seemed pretty fast in terms of like how quick it rebounded, and a lot of governments were pumping trillions of dollars into economies. And so, do you treat that as like an anomaly? I mean, obviously, a pandemic, no one expected that to happen, right? Do you treat that as like an anomaly in terms of like when governments come to the rescue, or do you see that as being something that could be a long-term trend in today's political environment?
Yeah, the government always does the same thing. If there's chaos, they step in and do all kinds of stuff, create plans and throw money out to everybody to try and save the markets. The pandemic, I would say that was kind of an anomaly. That's pretty different, right? But it's still the exact same thing happens. Like I'm a technical trader, so it doesn't matter what any of these dips and blips on the chart are based from, like what caused them. If you follow price and money flows, then you can navigate it. And the government will always step in and try and save the day, but from a really high level. And this is where my whole strategy stands apart. This is that hierarchy I was talking about. So I naturally always want to be long stocks, the SP 500, the NASDAQ. This is my hierarchy. And if they're not favorable, then I'll move to the next asset class that is non-correlated to the stock market, which could be going up. So bonds, or the US dollar index, or the inverse dollar index, or just collect monthly dividend payments and wait. And the volatility of each of these assets gets slower and lower and lower, meaning they move slower and slower. And typically, as you get to the bottom of this list, the markets are usually in some chaotic state, and we're safely on the sidelines having almost no volatility. In fact, this one, the only volatility is to the upside. It always goes up because we're just earning daily interest and a monthly dividend. But to go back to how COVID works, and if we apply our strategy of catching these waves, this is the market as we move through it with my subscribers and how we trade the ETFs. We were long the SP 500. Our strategy said, hey, trend is changing, money flow is moving out. We exited the SPY. It pulled back about 3% before we got out. And then we moved into bonds because bonds were in a strong uptrend. Bonds rallied with our TLT trade 19% in 9 days. It hit our 15% target. In fact, it gapped up above our target. We got out at 19% gain. And then we moved to this cash position. The US dollar didn't give us a trade at that time, so we went straight to cash. And then we collected a monthly dividend. And all that happened. So we made a fortune while the markets fell. And then we were sitting in cash while no one knew what to do. People were panicking, stockpiling food. They were worried. Many people were losing their money. The stock market was down like 34%. But the average investor who owns blue chip stocks, who their advisors say, hey, buy these big blue chips and they pay dividends, dividend stocks fall way more during a crisis and a financial reset than the stock market does. People don't know that. They're super dangerous. And that is because the majority of the big investors all own the same stocks. They're all into blue chips because that's the Kool-Aid they're all drinking from their advisors in the financial space. And when all those older people with the same positions start to panic, they all sell the same stocks. And so dividend stocks crash and get hit really hard. And so there was complete chaos. Meanwhile, we were not only wealthier and profited from the chaos in a very controlled way, but then we were sitting in cash and knowing our capital is safe. And then we were able to rebuy into the market because the next wave was starting and the stock market was rolling in. And then we played another huge move to the upside to grow even more. During that COVID year was a massive year, like 50% gain, while most people lost their shirts. So that's kind of how I navigate these markets. And you need to have a strategy that when one asset falls out of favor, we have to move to a different one. And if that's not in favor, we just keep moving down our hierarchy until there is one that meets our criteria. And there will always be one that meets our criteria because we have this cash bill position, just collecting treasury notes and making our 4.5% a year at this point, paid out monthly and in dividends. So that's how I go about, attacking these markets, and allows us to consistently hit new all-time highs because we're just rotating to whatever asset meets our criteria, fits our risk management and our hierarchy.
Hmm. Yeah, yeah, I see that. So when you're looking at, so I'm looking at this graphic here.
Mhm.
Something pretty much triggered like, okay, the S&P is going to go down, and then you moved into TLT, which is bonds. You saw bonds rise, and then you moved out of that and then into treasury bills, ETFs. And so, is this like a common thing throughout like market cycles where you see S&P, the major indexes fall significantly. People rush into bonds. Bonds get a big bid before I see a sell off in the TLT
Yep,
after
yep.
the 19% gain, and then usually me looking at the chart of Bill's like pretty stable. Um, uh, Throughout that time, it may go down a few cents, but you're not losing like 30-40%.
Yeah.
So is this like a common trend?
Yeah, it is. So the way Bill works is it's always paying out a dividend and interest. So it naturally, it has a very weird looking chart, but as long as you hold it for a couple of days, you're always making money with it, which is nice. But the bond market isn't quite as you said. In the past, it's always been the scenario. If we get out of stocks, we generally move into bonds like TLT. But obviously, that we're in a rising interest rate environment. So the chart of bonds, this was the peak. We literally got out right at the peak, and we haven't been back into bonds since because they're not in favor. Interest rates are going up, bonds are going down. We're seeing a pretty massive correction across the board. Bonds down 40%. So it's not the norm now. And that's the nice thing about what I do is I don't use just, what everybody does and has done in the past. We follow price. If bonds don't meet our criteria, we don't get in. And the problem is everybody else has been moving into bonds, or they never got out of bonds, and they've seen their bond portfolios portion fall like 30-40%. And that's why you need to follow price and manage positions. And nobody does that. They stick with these old philosophies of, diversify, and bonds should do well. But of course, bonds are going to do well if rates are falling. They've been falling forever, but now we're in a rising environment. The game changes. You have to change your portfolio. You don't just stick with what worked in the past, because what worked in the past eventually isn't going to work in the future. And so that's why I follow price. We don't predict price, and this is what I think there's a big disconnect. People always think like, hey, you're trying to pick tops and bottoms and market time. I'm like, well, not really. I definitely do not try and pick a top or bottom. I might call and say I think this is a top or bottom. We don't trade that. What I do is follow price. When a new trend starts and there's lots of momentum behind it and all of our technicals confirm saying this is a real trend, this has got legs behind it, then we hop on there. We ride the coattails of the market. So we never buy in near the bottom. The trend has to run for quite a ways before we get in. For example, if I was to pull up this chart of the SP 500, I mean, there was a pretty significant rally from the low to our entry price. We missed 7% move, but then we ended up catching, we hit targets along the way, and we got out for a nice gain. And then there was another big rally recently, and we're long the markets. We've already hit a target, but we miss out on, the first 5, 6, 8% of a trend because we need to wait for the trend to confirm and say, okay, this is the real deal. This isn't a bounce. This is the start of a trend. But people always think they need to buy low and they need to make sure they sell near the top. But that's not the case. If once people realize you can't buy the bottom and you can't, sell at the top. If you do, it's a total fluke. You just had some good analysis and you lucked out. But eventually you're going to say you're going to sell it at the top and it's going to take off without you and you're screwed. So never try to pick a top or bottom. Wait for a trend to confirm. Ride the trend until the trend has rolled over. You're going to give back gains, and then get out when the momentum in that, we know that wave is toast, right? So that's how I follow it.
Yeah, yeah. That's you answered a question that I was going to ask you next, because I saw on the previous graphic where when the S&P was falling, you were in T-bills, you were in bill, and then you got in when the trend started to establish itself. And so I appreciate you explaining that, because that's very helpful to understand. I mean, obviously, there's a saying, "Don't catch a falling knife," right? And so it seems like, in your trading strategy, you're waiting for the trend to establish so that you don't catch that falling knife, right? So yeah, I could see that. Well, Chris, man, I just appreciate you for coming on. Where can people find more about the work you do and the services you provide?
Yeah, they can go to thetechnicaltraders.com, which is my website. If you go to my website here, you can learn all about the strategy that I implement. Like, we really only have one shot at retirement. That's my whole focus. I want to protect. I help people who are retired make more money than they've ever made, which is pretty amazing because we have these consistent returns. But you can go to my website, check it out. If you go to my YouTube channel, where I'm at thetechnicaltraders.com, on YouTube, you can follow me there. And I do, usually one update a week to cover the markets from a very kind of granular level and I cover all the asset classes. So they can follow me there, or my book, Asset Revesting. You can pick up on Amazon or anywhere else if you want to learn this style, or, see if this style is for you. I provide my signals as a newsletter, but I also have auto trading. I know a lot of people don't want to learn trading. They still work, and they just want to execute it in their account for them. I don't charge anything for the auto trading. I believe it's the best way because it gets the individuals away from screwing up the trades. They skip trades. They don't get out when they're supposed to. So you can really copy the trades that I do. Yeah, I got a free newsletter. They can join if they visit my website as well to stay caught up on the markets.
Okay. Sounds great. Thank you for coming on. We got to have you back sometime. I appreciate you for investing your time in us today.
Yeah. Thanks, Daryl. It's a pleasure. Take care.